We're live.
We're live? Oh, cool. Hey, everybody. So for those of you who've joined us online, we're in a room full of, I don't know, 25 people. I think this might be a record for NowLab workshop talks. For those of you who don't know what a workshop talk is, it's not like we're just talking at you the whole time and you get bored and fall asleep. It's more like we're trying to get you to think of questions to ask as we're talking. So keep track of all your questions throughout this entire talk. And at the end, we're going to get a full half an hour to go through questions. So it's a half an hour of us talking and then a half an hour of you guys asking us very hard questions so that we can dive deeper into the topic itself. This is the format that we've kind of tried to pioneer the NowLab, and hopefully it works out. It's a bit of an experiment. As Dave Meeker mentioned on the general channel, we've never actually done a live stream before, so this is our first time, so bear with us. There may be problems. With that said, Alberto, take us away.
Thank you. So I'm happy to talk to you guys today about blockchain and Bitcoin in general, because hopefully we can turn this Bitcoin topic into sort of a Isobar kitchen conversation now. So what is actually blockchain? So blockchain is one of those technologies that's very hard to describe, but it's very revolutionary. And I think we believe that blockchain is going to lead the way into the next digital revolution, and that is Web 3.0. And Web 3.0 is really about the democratization of data. So if you compare that to Web 2.0, Web 2.0 is actually the commoditization of data, which is, if you hoard more data, that will actually, in fact, give your business a lot more value. And that's the opposite with this new economy, the blockchain economy. So Leigh is going to give us a quick intro on that. I will give you guys a quick intro on Bitcoin, how Bitcoin works, and what is blockchain. And then we'll talk about what is the Ethereum blockchain, which is far more interesting blockchain than the Bitcoin blockchain, in my opinion. And then we'll talk about how that will disrupt brands and how that could be used.
So let's start out by talking a little bit about fads and scams and hype cycles. As you know, I spent a lot of my time trying to figure out, whether a technology is overhyped and it's just going to be a temporary fad, or whether it's going to be something that sticks with us for a long time. I have to admit, when it comes to Bitcoin and blockchain, I first started buying Bitcoin maybe 4 years ago or something like that, and Ethereum maybe a year and a bit ago, and I actually thought they were fads at the time, but I was like, just in case they're not, I'll just play around with them a little bit, and, see what they're good for. But as I did this deep dive along with Dave Meeker and many other people on the hashtag blockchain channel on Slack, I realized more and more that this is really not just a hyped up thing that's going to go away. It's going to probably be with us forever. So I don't know if you guys ever heard of the tulip mania of the 1600s. There's this time where tulip bulbs sold for more than a multi-family home in Holland, and so that's a really expensive tulip bulb, right? So they called that a bubble, a classic case of mania. And then just as fast as the prices of tulip bulbs went up, they dropped just as quickly. And it's very tempting to believe the media when you read a headline that says, "Oh, Bitcoin's just like tulip bulbs," right? It's very tempting to think that way. But I actually think a better analogy for blockchain is actually the internet itself. So the internet did create a bubble when it first came out, as it probably inevitably was going to, because the technology has held so much promise that created a mania. And manias do tend to cause these bubbles to rise very quickly and then burst. So that's just sort of something to keep in mind throughout this conversation. We're not here today to hype up blockchain or hype up Bitcoin. We're really here today to cut through the hype and cut through some of the BS and try to get to the heart of the matter, talking about what it really is and ultimately in the long run, how it's going to affect brands just in the same way that the internet has and social media has and mobile has. So.
Well, so what is actually Bitcoin? Forget everything you know about Bitcoin right now, and we'll start with basics because this is really important. There's a lot of confusion, again, with what people know about Bitcoin. So first of all, Bitcoin is not a blockchain. Bitcoin is not money. Bitcoin isn't a company, product, or a service, actually. Bitcoin is actually a network protocol, and it's a software that's open source, available for anyone to download. Anyone can see the source code and make sure that there is no malicious intent behind it. But what do I actually mean by internet protocol? So today we use the internet. These are actually some of the most commonly used internet protocols. And today we use them sort of for granted because all of this magic happens under the hood of our software. And we don't really pay attention to what this really is. And what a protocol really is just an interface for softwares to talk to each other and understand each other's data. That's all it is. And if we take the SMTP protocol, for example, for the emails, when we try to send a file over to someone, we can put the digital file in attachment in your email, type in their email address, and then we can hit the send button. And on the other end, the person receives that file. What they, in fact, receive on the other end is just a copy of your digital file. You're not actually physically moving one file from one place into another place. While this works in most cases, what actually happens when we try to send something with monetary value, like money itself, that would create rampant inflation. It would obviously devastate the economy. So this is a known problem as the double spending problem. And it's been a known problem with previous digital cash schemes like B-Money, Cash. And one proposed solution to fix this double spending issue is to introduce a centralized system to manage that trust. But what happens when we actually trust an intermediary with too much of our private information? Well, what do all of these companies actually have in common? They've all been hacked in the past. And so what Bitcoin proposes is an alternative paradigm, and this is decentralization. And decentralization in comparison to the centralized system is, the centralized system has one center and focal point of attack. And when that system gets compromised, the whole ship goes down with it, basically. And with the decentralized system, if one node goes down, the remaining of the network can continue as business as usual. But one use of this decentralized system, the Bitcoin protocol, is a currency which also happens to be named Bitcoin. And Bitcoin as a currency is not a gaming currency that you might encounter in your typical video games. It is also not a payment network like PayPal or Venmo. This is a direct push payment system. And this sort of transaction of currency is known as a cryptocurrency. And what is a cryptocurrency? Well, if you compare the centralized system, when you try to send some money over to someone, the banks, the central authorities aren't actually moving the money physically from one bank into another bank. What they're really doing is just changing numbers in a ledger. This is how they keep track of who owes who what, right? And this ledger is really a accounting system known as the double entry bookkeeping. It's one entry that's a debit on one account and a deposit onto another account known as a credit. Now, if we actually take that ledger away from a central authority and give that ledger and allow everyone to manage their own piece of ledger, this is what we get as Bitcoin. And this ledger is really the blockchain. It is one of the 4 components that makes this decentralized system work. But of course, because this ledger is public, you don't want your private financial information to be available for anyone to see. So the blockchain introduces a cryptographic concept that anonymizes every user. And this is a wallet ID. It is really a public key. The public key also has a private key. This is a key pair. For those of you in computer science will understand this. We use this for SSH. So the public key is really just sort of like your checking account. You might give someone your routing account information, and that won't actually compromise your account. You will actually need the private key to transfer money to another person. And the private key is really like the password into your banking account. Now, if you take that ledger and you distribute it everywhere, now everybody becomes a bank. So what is blockchain? It's really just a ledger. And with the ledger, you don't actually have to transfer money. You can actually transfer digital assets like emojis, movies, or smart contracts.
All right, thank you, Alberto. Like I said, we're going to leave a ton of time for questions. So hopefully, you guys were thinking about what questions you want to ask throughout Alberto's talk about what blockchain and Bitcoin are. I'm going to say a few words about what Ethereum is, and hopefully that launches us into multiple possibilities of what we can do with brands for brand commerce. So what's Ethereum? You might have heard of it before. It's actually by this kid named, he's like 21 years old now, but at the time he was a teenager when he invented it. But he was working pretty heavily on Bitcoin. His name is Vitalik Buterin. Is that how you pronounce his last name? And he's based in Canada. Shout out to Canada. And he basically was working on Bitcoin blockchain and on publications and things like this, and realized pretty quickly that if he abstracted what the Bitcoin blockchain was, that he could make it possible to turn it into a platform so that people could launch tokens very easily and very quickly. And as a result, this has led to the possibility of smart contracts, where you can have a set, what people describe as a Turing complete blockchain, right? So you can do any calculation you want on chain, and you can put in loops into the blockchain. So you can actually have recurring payments and things like this. Now, some people on the Bitcoin side say that that's really insecure, so they don't want that, but that's pretty much the Ethereum challenge, is how to make that secure and reliable. And in addition to that, also, it creates the possibility to have what people call dApps, or decentralized, or some people say distributed apps. These apps are essentially like the apps you have on your phone, or like the ones you'd have on the web, but rather than being hosted by some central server that's vulnerable to attack, just in the same way that every website and every app currently is, you could in fact have it so that's fully decentralized, and the entire back end is completely, well, much less vulnerable. I won't say completely, but much less vulnerable to attack. So in that context, how will brands be disrupted? Well, there's a huge list here, and I'm not going to go through them all, but as we go through Q&A, we'll probably dive into more of these in some detail. That's one of the things I'm hoping to get out of this today, is that we're able to sort of dive a little deeper into dispelling some myths, helping create a better understanding, but most importantly, to collectively gain a better understanding here at Isobar about how brands will be disrupted by blockchain. So before we start doing that, though, let's just do a little recap here on definitions based on what you just heard today from Alberto. So for blockchain, we created this definition ourselves based on a concatenation or amalgamation of many different definitions that we found on the internet. But we're using the phrase, it's a publicly accessible, transparent, and persistent string of time series data that's connected using a hash system, validated through mathematical consensus, and that can serve as the only source of truth for a given set of events. So this is a very, very unusual beast. There's a lot, that's kind of a bit of a mouthful, but The reason why it's such a mouthful is because of the this sort of the profound impact that something has when it's an immutable truth, or the closest thing we've ever known to an immutable truth. So in this sort of post-truth world, right, that many of us are very frustrated with, with fake news and all that kind of stuff, we now have the basic building block for a decentralized truth. So blockchain is that. So notice I didn't say anything about money or currencies or anything like that. That is blockchain. So just separate the concept of blockchain entirely from any kind of cryptocurrency as much as you can, because I think that opens us up to more possibilities in our thinking. On the cryptocurrency side, the definition that we've gone with is really simple: a chunk of code that uses a blockchain to represent ownership of a digital asset as a form of an IOU. I mean, that's really how simple a cryptocurrency is. It's an IOU that's powered by a blockchain. In fact, you can actually have, some people would argue you can have cryptocurrencies that don't use anything that remotely resembles the Bitcoin blockchain. And we've already started seeing those. There's actually many different cryptocurrencies that are popping up that are, believe it or not, that are actually pegged to gold or pegged to the US dollar or pegged to a barrel of oil. Venezuela, Russia, many different countries now are launching their own cryptocurrencies. People call these fiat crypto or national crypto. They're usually not decentralized. They're usually somewhat distributed, but not decentralized, but still cryptocurrencies in their own right, depending on your definition. And last but not least, the definition of Bitcoin, the world's first digital currency, true cryptocurrency, and a worldwide payment system. This is the easiest way to remember. But it's not a payment system, again, as Alberto said, not a payment system in the sense of PayPal and Venmo. It's one that doesn't really belong to any individual or any corporation. That's a pretty revolutionary thing. All right, so let's talk about disruption now. Again, I'm not going to go through all of these, but I will save a lot of time. So if you want to talk more about these different topics, we'll circle back onto these later. So I've broken these up into three categories: prevention of fraud, theft, and piracy. Then I talk about efficiency, trustworthiness, and privacy, transparency. And then I talk about devices and servers, like hardware, essentially. So starting with prevention of fraud, theft, and piracy. So anywhere where fraud, theft, and piracy are rampant, blockchain will serve a future purpose. That there's no doubt in my mind. So smart contracts are a really good example of this. Obviously, people are often committing fraud while they're under contract. But if you automate payments and you automate deliverables with blockchain, then it's automatic. You don't have to wait till someone writes you a check and rewards you for good behavior. The blockchain itself doles out your payment as a result of your behavior. And your behavior is data-driven. Your behavior produces some sort of data that then goes onto the blockchain and then causes that transaction to happen automatically. That's at the heart of what a smart contract is, in my opinion. Then there's advertising verification. So obviously there's a lot of click fraud. I'm sure you guys spend a lot more time on that kind of thing than I do. But it's a huge problem with banner ads and things like this. So if you can get rid of that, it's looking likely that blockchain could be a really great solution there as well. I would say definitely not proven yet, but things are moving pretty fast in that department. There's obviously things like micropayments. So with cryptocurrencies in general, you can have what's called a Satoshi, which I believe is 100 million. Is that right? So it's one over 100 million of a Bitcoin. So it's a pretty small number, and it's named after the guy who invented Bitcoin, Satoshi Nakamoto, who to this day no one has any idea who he is. There's plenty of suspicion, but there's a bit of mystery there, which adds like kind of a bit of lore to the whole thing, which is kind of funny. Then there's licensing of media. So this makes perfect sense, right? For media companies, you can make it way easier, way quicker, and much more efficient for people to license media, use it, and pay you for it, all in a way that requires almost zero lawyers and zero accountants, which obviously cuts down on cost and makes things more efficient. Then there's the, I just call this last category auditable. So anything that currently gets audited, like taxes, for example, but not just taxes, obviously, then that's a place where blockchain is going to help a lot, because then you can write code and you can take advantage of artificial intelligence to do the audit rather than a human. So lots of efficiency to gain there. And it's a bit ironic, right? Because Bitcoin is kind of it was used for like the Silk Road, and it's been used to like trade things on the black market. So in general, we assume that cryptocurrencies are sort of almost synonymous with the underground or piracy. And so it's kind of ironic to say that really this exact same technology is not only is causing these problems, but is also fundamentally could be the solution to these problems long term. So a little bit of a strange twist to the story. So let's talk about efficiency, trustworthiness, and privacy transparency. So first of all, when I say privacy transparency, what I mean by that is that people, of course, they can abuse blockchain just in the same way that people abuse the internet, right? But it gives the possibility for privacy transparency. It gives the possibility for you to take your privacy and say, this is important to me, and I'm going to go look at the source code for this blockchain to make sure that my privacy is ensured. It's that transparency really that enables you to claim back your privacy should you want to. And that's true for customers in general. So a lot of brands are going to struggle with this. As people use the blockchain to regain their sense of privacy, there's going to be a very transparent process by which you say, this is what I'm willing to give you, and this is what I'm not willing to give you. Or maybe this is what I'm willing to give you, but at a price, right? So that whole conversation right now kind of happens somewhat subconsciously for most brands. But I believe that it will be a much more conscious process in the future, or it certainly could be anyway. Another example would be reward programs. So any kind of loyalty program, where there's potentially some kind of CRM. In fact, that's actually another one of the categories here. I kept it separate than reward programs, because you can think of these as mega databases, right? If it's a mega database and there's tons of properties for each entry, blockchain is a really great way to store that information in a distributed manner that is very unlikely to be hacked. And that's, I think, what people are looking forward to, right? So your data being protected in a way that's distributed, but also that you have control over. Then there's things like better KPIs, so just measuring stuff in general, helping consumers understand their own data, and allowing consumers to sort of engage with brands on that level. And I already mentioned data transparency. Okay, so what about devices? What about hardware and servers and things like this? So the Internet of Things is a great example of something that can leverage cryptocurrencies and the blockchain. So for cryptocurrencies, what you need is a currency that can have almost no fees, it's instantaneous, and you can divide it into tiny, tiny little pieces. Because sometimes when the camera needs to talk to the TV or whatever, when those machines speak to one another, the transaction is going to be 1/1,000,000th of a penny, right? It's going to be the tiniest little amount of money to make that transaction happen. And it really makes sense to have a cryptocurrency, because it doesn't. You try to divide up, fiat currency into such small amounts, it's very cumbersome, and typically the transaction costs are too high. Cloud services is another one. So anything that you do on Amazon servers, any kind of cloud service, that can be done either on chain or on a second layer. Just think of like things like Ethereum as like giant computational networks. Right now they're pretty slow in terms of how many computations they can do per second. I think it's like 10 or 20 or something. It's pretty low, but that's growing exponentially. But maybe more importantly is you can also have the distribution of files themselves. So anywhere where you're storing an image or a video file, that information can be stored across potentially millions and millions of different little mini servers all around the world on chain. Sorry, when I say on chain, I'm saying on. It's a term for something being done on the blockchain itself, as opposed to some kind of second layer. The other is supercomputing, so distributed computing on a global scale. That one's kind of obvious. And then this last one is kind of scary, is artificial intelligence. So it could be the case that these cryptocurrencies and their rampant scaling up of computational power is actually maybe the right tool to enable artificial intelligence. So if you want to have something that's more powerful than any supercomputer that's ever existed, which arguably for a very narrow use case, the Bitcoin blockchain already is. Obviously, all it can do is hashing, which is maybe not that helpful for anything else other than cryptography. But if you have a more generalized AI platform on something similar to Ethereum, then in theory, you could have a decentralized AI. And we have to ask ourselves, philosophically, is this something we want? I mean, do we really want to have an AI that no one owns and no individual can control or shut down? That's a little bit terrifying. So yeah, I'll leave you with that. I'm not terrified of this happening, but I'll say that we certainly should be as aware and vigilant as we can be about these kinds of possibilities. So yeah, we've got lots of other applications here to talk about, and we have. I think we should talk about CryptoKitties first before we open it up for questions, though.
Sure.
Yeah, you want to switch? Let's do it. CryptoPunks and CryptoKitties.
Sure. So CryptoPunks and CryptoKitties, they're very similar. So Leigh talked about the Ethereum blockchain earlier, smart contracts. We don't actually have to transfer money with the blockchain. So think about transferring avatars to another person. Now you can have proof of ownership for digital art. That's what it really is all about. That's what CryptoKitties and CryptoPunks.
Yeah, so I'll squeeze in frame here. Hopefully you guys can see. You can see where you're. That's fun. I think you can see us both, right? This one's really great. I love Golem. Golem is their explicit goal. They have like $1 billion crypto market cap, which pales in comparison to Ethereum and Bitcoin, but still a pretty big number. And their goal is to make the world's first decentralized supercomputer that has a high number of calculations per second. That's sort of their objective. It's kind of a noble goal, really.
Yeah, I think people can compare this to like Amazon web hosting services, but not owned by Amazon, and this is just computers scattered across the world. Combine it.
So is that our last slide? I think we're opening up for questions now, right? Yeah. Okay, great. So we have some slides in the appendix that we can refer to during questions. I'll be taking questions on the NowLab Slack. Hey guys, can you see me? All right. So Slack me questions. Alberto will be taking questions from the audience here, and then we'll go one for one. Audience Slack, audience Slack. Sound good? Okay.
We already have 2 questions on YouTube.
Oh, we already have 2 on YouTube. Okay,
Yeah.
Sorry. We'll be taking them from YouTube and Slack. I take that back. I meant to say YouTube and Slack. So let's do the first question from YouTube. I can launch it on my phone too, if that's better.
Question. Okay. So the first one was from Patrick Cleary, and I guess he was commenting for a specific example. If sorry, I'm not sure I'm the best person to use.
Yeah, I'll launch the YouTube right now. Yeah.
I can read the questions out.
Yeah.
Patrick Cleary asked, I imagine an example of a cloud service in this context could be IPFS and Filecoin.
I'll let you take that one.
Yeah, so it's interesting that the Ethereum blockchain is actually not accessible to your typical web. You actually require a plugin to get into the network. I think this plugin on Chrome is called MetaMask. Essentially, Ethereum is considered the dark web, and so it's another layer in the web. So in order for the Ethereum network to come to public network, we require something like the IPFS system to bring it forward. So there's I think a couple of libraries, software libraries out there that are trying to make that happen. They're not mature yet, but they're sort of proof of concept.
Great question, though. That's a great question. All right, let's take the second YouTube question, and then we'll take questions from the audience.
So from Brandon Vandegraff, can you talk about proof of stake versus proof of work?
Sure, I can do that. I have some pretty strong opinions about that, so I'm going to try to not say my opinion and just state some facts, and then I'll say a little opinion. So proof of work is very computationally intensive. It relies on, at least for Bitcoin, 256 SHA-526. And what that means is that it's 256 bits. That's how long the keys are. And if you look at a hashing function, as you probably know, when you have 256 bits, that's, I think it's the number of guesses that you have to do. I mean, it's kind of insane, actually, how unbreakable that is. You can go one way in the function, but trying to go back the other way is nearly impossible. And so, so I think that maybe is the most important aspect of proof of work, is that it makes it almost impossible to get let me make sure I'm getting this right. Yeah. To guess what the private key is, or somehow hack and find out what the private key is if you've been given a public key. So going in that direction is extremely difficult, but going in the other direction is trivially easy. So proof of work is the process by which you force all the miners to basically brute force through what they call hashing in order to figure out what that private key is. And every time that's done, every time someone succeeds at that, is roughly every 10 minutes, and they discover a block on the blockchain as a result. So that's proof of work in a nutshell. Proof of stake, there are actually dozens of different versions that I've seen, some of them more secure than others. At first glance, it sounds very nice. You take your coins and you stake them, which means you're putting them into essentially a wallet of some sort that proves that you own them. So it's sort of like proof of ownership in some ways. And because you own them, you can then use that proof of ownership to help secure the network and to reach what people call consensus. So if all the different staked coins agree on what the blockchain is, then that is the blockchain. Now, the downside to this, of course, is that you might have people pretending, right? You might have people that have been on the network longer than others, or you might have people who own more coins than others, and that'll cause a centralization of power. So this is one of the reasons why people, and this is kind of my opinion, are wary or nervous about proof of stake. But the belief is that if we spend enough time focusing on how to decentralize nodes in proof of stake, that we may achieve a similar level of security that we've managed to achieve with proof of work. I hope that answers the question. There's obviously a lot more to it than that, like sharding and Casper network, but I don't think we have time to go into those today, unless you guys really want us to. So let's take a question from the audience. Yeah, go ahead.
Can you give an example of something? Is there something, a large like Fortune 500 company that already is doing something with this that can be really like P&G or somebody like that that's
sure.
using blockchain?
Yeah. So the number of companies in the Fortune out of all Fortune 500 companies, the number of companies that are experimenting with blockchain, my guess is probably like half at this point. The number that have released things publicly is pretty small. Overstock.com is a company that has, I would say, embraced this technology very early on. They accepted Bitcoin payments, I believe, for the longest time, and they started actually working on their own ICO. Then there's sort of like more hypey examples of like companies that kind of jump the gun a little bit, like Kodak launching their own ICO as well. Maybe a bit of a media play there. It's not entirely clear to me how sincere they are.
So the Overstock example. Right. So the Overstock example, they're accepting Bitcoin. So what does that mean? That means that like you transfer like from your wallet, you just prove that you have a Bitcoin in your wallet, and you're like,
yeah. So you don't need to prove that you have it in your wallet. That proof is inherent to the blockchain. So the minute if you were to try to transfer a coin you didn't have, it wouldn't work. The distributed network of miners would reject that entry on the blockchain. So you don't have to worry about that. But if you have a wallet and you have Bitcoin in your wallet, or even on an exchange for that matter, which has its own wallet, you're able to just transfer that anywhere in the world. And you can actually set, believe it or not, you can set the transaction fee to prioritize. So if you want to like make sure your transaction goes through on the next block, you can actually crank up the transaction fee to ensure that that is the case. So it'll go through within the next 10 minutes. Or you can turn your transaction fee way, way, way down because you don't care how long it takes to do the transaction. So you can do a Bitcoin transaction for like a fraction of a penny if you want to. You might be waiting a while, but so when people say, oh, Bitcoin transactions are really expensive, what they're really saying is fast Bitcoin transactions are really expensive. If you can, and in some cases, during like a really boring period, cryptocurrency transactions can actually be fast and cheap. It's only during these phases of mania that it gets really expensive. So companies like Overstock.com wanted to take advantage of this, right? There's all these people out there with Bitcoin all over the world. There's people in sub-Saharan Africa using Bitcoin, right? There's people in Venezuela, with hordes and stashes of hodlers hodling their Bitcoin. So if you're a brand and you want to gain access to these customers, these consumers, a really great way to do that is to open up your platform to accept various cryptocurrencies, preferably the most popular ones. So that's sort of like a more obvious example, but I think that maybe a little bit more of a profound example, I would say, is probably Microsoft. Microsoft at this point has hired up a ton of engineers to work on cryptocurrencies and to work on various blockchain research. And they've actually started publishing white papers and making very public announcements about what technologies they think are going to win. For example, they recently came out against doing everything on chain. They're big believers in doing some things in what they call layer 2, which is where you have other systems surrounding a blockchain that are based on the blockchain, but where the calculation itself is not done on the blockchain. So they're in favor of these second layer solutions. One example of this is something called the Lightning Network. The Lightning Network is a layer 2 solution that allows for faster transactions and hopefully doesn't compromise any security.
Question.
Yeah.
Could you go like 4 slides back? There was an interesting one more. Yeah, that. Wait, one more back.
Can you, whoever's asking the question, can you speak up so people on YouTube can hear?
I just wanted to have that there. So
I'll repeat the question. So Kat was asking us to just head back to a previous slide that we're showing now. Probably pretty hard for you guys to see on YouTube what it is that we're looking at. These are just like this is just a list of other applications. There's a pretty long list here. Some of these have nothing to do with brands. Some of them do, but we just sort of threw them up here in case anybody brought up any questions today. We can revert back to this, but was there anything in particular that caught your eye?
No, I just kind of wanted to have that in the background and look, but I do have another question.
Yeah, go ahead.
Do you think LTC, Litecoin, Amazon's going to use it?
Ooh, speculation. I don't know. Alberto might have an opinion.
What's Amazon going to go with when they start allowing?
Amazon?
I'd say they do their own.
Yeah. That's
Everyone's a little bit terrified of Amazon launching their own cryptocurrency. People who really understand decentralization understand what's at stake here, right? Like if like the internet was like open and free and distributed, right? And then like along came Google and Facebook, and suddenly the internet isn't so distributed and open and free anymore, right? And that's not, I'm not knocking Facebook and Google. I love Facebook and Google, but like we have to admit to some extent when you have very powerful corporations that have I guess Google doesn't really have much of a walled garden, but Facebook certainly does, right? So once they start doing that, that can be an issue. So if Amazon launches their own, centralized cryptocurrency, but it's sufficiently well accepted throughout the world, then we would essentially have a centralized, we could potentially have a centralized cryptocurrency, which I believe will be less secure, less equitable, and will suffer from efficiency issues just like every other centralized system. So it'll be a big battle, and we get to watch it. It's kind of exciting, right? We get to watch this war play out in front of us, and we also, because we're here at Isobar and we have some of the best coders in the world, we can actually take this information and help guide things in the right direction. And that's a really big responsibility, and I'm really excited to be a part of it. So we have time for probably about 5 or 6 more questions. So
there's also another YouTube question.
There's more on YouTube? Okay,
yeah,
great. Go ahead.
The next one is from Patrick Cleary. If mining in a proof of work system represents the correct guess of a private key, what does mining represent in a proof of stake system?
So you can't. So there is no mining in a proof of stake system, but you can get paid for staking your coins. So rather than mining by applying huge amounts of computational power, you would sort of mine new coins. It's the wrong term, but by staking your coins, and that's how new currency is introduced into the system. The beauty of that, of course, is because there's no mining, is that you're not wasting electricity on what is otherwise useless guessing and checking of hash keys. So some people argue, though, that there is a certain beauty in this forcing function that's causing a huge uptake in GPUs, ASIC development, and other sort of distributed supercomputers. So some people don't really want the mining to go away. It's kind of a beautiful mechanism by which we can build these distributed computers. But if proof of stake is truly successful, the amount of computational power that it'll require will be orders of magnitude less than what is required currently for Bitcoin. Monica?
Okay, so you talked about cryptocurrency, and now we, the whole concept of cryptocurrencies, decentralized, coming from blockchain. But how does it work? Like the whole Fed system and the government and the banks is also
right. Yeah. Now we're getting a little
centralized, and that's how we talk. I mean, I deposit all my money in the bank, so is everybody else.
For sure. Yeah.
So how are there going to be any regulations? And if they are, how is that going to affect cryptocurrency? And what should the people, the second question, part two, is what should people be wary of, the people that have a lot of Bitcoins and have a big stake on it?
Okay, so there's two questions there. The first question is given that our entire society runs on competing centralized forces, that's the way modern capitalism basically works, and I think the USA is a particularly good example of where that can be highly effective, to have sort of, they say, checks and balances, so to speak. So will regulation come into play to regulate cryptocurrencies and Bitcoin as a result of feeling threatened, presumably, by this? And then the second question was people that do have lots and lots of Bitcoin. I think we all probably know, everyone in this room probably knows somebody who invested in Bitcoin, 5 or 6 years ago, and now is like, sitting on this pile of virtual money or whatever. So, the question is how screwed are those people? If there is a ton of regulation, how bad is that going to be? So this is kind of diving more into like the investing side, which is really not what this talk was about today, but I'm happy to do my best to answer that. And then hopefully we'll get a little bit of, I think Alberto and I have some disagreements on this, which is probably a good thing, because by no means do I know what's going to happen. No one really knows what's going to happen. So let's do a little speculation. First of all, we will see regulation, for sure. We already have. There's this wonderful documentary called Banking on Bitcoin. It goes through the pros and cons of regulation through narrative and story. I highly recommend you all check it out. It's really fantastic. There's also a wonderful blog post and white paper written by a British economist, I guess. It's called An Investor's Take on Cryptocurrencies, I believe.
No, I forget.
I think it's something like that. I'll send out the link right after this talk, or maybe someone who knows what I'm talking about can post it on the Slack and on the YouTube. Fantastic white paper. It's a little long, but if you just sort of read the summary and the conclusion, you'll get the gist of it. It basically goes into explicit detail of what the killer app for blockchain and cryptocurrencies has been in the early stages. And that's what people call a proof of ownership or a store of value. So gold is a store of value. Offshore banking, storing currencies in offshore banking has been a store of value globally. That number adds up to something like $40 trillion. And for most people, storing US dollars in some offshore bank account really isn't that great. They're just doing it because that's their only option, if they want to protect their assets from a malicious government or whatever. And so that's a lot of money, though, $40 trillion. And the Bitcoin, market cap is at what, 200 and something billion right now? I don't remember. So maybe some
400 something. The total. Oh, the Bitcoin itself.
Yeah, the total market cap of all cryptocurrencies is 400 and something billion, and then Bitcoin is roughly half that. So a little less than half that. So the argument would go that cryptocurrencies have a very long way to go Now that said, I think we can all say, based on this recent correction, I mean, it corrected by 75% in less than a couple months, right? So we're talking about an asset that is way too volatile for any sane person to recommend as an investment tool. Maybe it is a good investment tool, but you'd be crazy to sort of go and recommend to your friends and family, like, buy Bitcoin, right? Because it's so volatile, you don't know what's going to happen. It could go to almost zero, right? Or it could go to the moon. We don't really know. And anybody who says they do know, they're probably lying. And I think there's a lot of fear, uncertainty, and doubt in this industry. And it's a very manic, depressive sort of oscillation. So I don't think anybody can really say what's going to happen. But what we do know is that the disruption is going to happen. That we can say with certainty. The blockchain will disrupt. And with respect to regulation, which I think was the core of your question, we've seen regulation already. We'll see more of it. We see heavy regulation in China in particular. We're starting to see other countries near China, usually in Asia, starting to limit what can be done, especially with respect to ICOs, initial coin offerings. But we also see countries like Japan and the US that have actually been surprisingly willing to let this experiment run its course, in part because Americans are really angry, right? After 2008, it sort of felt like there was no resolution to that banking crisis. And there was a huge bailout, and everyone sort of said, well, this sucks. We're just going back to the status quo. We're just going to repeat the same problem all over again. And no one wants that to happen again. And a lot of people see blockchain as a potential solution to prevent that from happening again. So I think that's one of the reasons why we're seeing, let's call it measured regulation. And there's many people that work on cryptocurrencies who actually want regulation. They want the legitimization of having their cryptocurrency partially regulated so that there's less fraud and there's less bad press around fraud. So does that answer your question?
What?
Alberto,
I can't pronounce their name. The twins.
the Winklevoss twins?
Are they opposing regulation?
No, they're in favor of regulation.
They're in favor.
Yeah, they're from the two. They have over $1 billion worth of Bitcoin, and they're
right.
two of the largest crypto investors in the world. They've done very, very well, and they're very comfortable with Bitcoin going to near zero. So they're one of the few investors where they've said publicly, like it could drop. I don't remember what percentage they said, but but based on the way they're talking about it, they're in it for the long haul. And what that means is that it's relatively independent of the actual price of the cryptocurrency. It's more about making it as legitimate as possible and as many people using cryptocurrencies as possible. That's really the goal of what they're trying to do. And they see regulation as a way of making that possible. It seems a little counterintuitive, but it's not that out of the question that they'd be correct. Alberto probably, I think we argue about decentralization quite a bit and about privacy concerns and regulation. So I go ahead and say what you need to say.
I think I'll hold off on that.
You're gonna hold on, yeah. Too political hot potato. Is
yeah.
That? Yeah. In private, Alberto and I will answer your questions about the political aspects of cryptocurrencies.
So we have 2 questions on the NowLab chat. Do we have any more in the audience?
Let's do another one for the audience first, and then we'll go back to the YouTube.
So my question is, there's like a bunch of different cryptocurrencies. What's sort of the differences between them? What makes one more valuable than the other? And
This is definitely an Alberto question.
sort of related is like, why would a sovereign want to get into their own cryptocurrency?
Cool. I can answer the second part if you go to the first part.
Yeah, I mean, I think and you can't stop anyone from creating their own cryptocurrency.
Mm-hmm.
This is sort of a liquidity sort of preference.
Okay.
I guess you can go with the most popular one, maybe, but you just want to make sure you got to do your own due diligence here to make sure that they're actually decentralized and not centralized, and also make sure that the software is actually open source and it's not like done behind closed doors and you don't know what's going on behind the mat there. Okay. So I think that's what sort of gives people confidence in the coin, and that's what gives it value.
There's dozens of examples of that. I mean, one of the ones that Alberto turned me on to is called Monero. I'm a little afraid of Monero because it's so incredibly anonymized, and that could be an issue, right? You can actually get more fraud if you can never trace the transaction back to a person. There's this thing called Know Your Customer, KYC, yeah. So for any of you guys who've done anything with Bloomberg, you're probably familiar with this. But yeah, I mean, know your customer is core to cryptocurrency regulation.
Yeah.
And what that means is that if someone does something, so you're anonymized, so people don't know who you are. It's not publicly available who you are because your name on it's not like your name is on the blockchain,
Yeah.
but your wallet ID is, right? And so if the government really needed to know who you were because you're doing something bad, they could figure that out because of KYC.
Right.
So that's a fairly good future in my opinion. But these cryptocurrencies have kind of swung the pendulum so far to the privacy side of things. There's now dozens of what I call anon coins, and they're very powerful tools, and they're very there's quite a few of them, and they're doing quite well. And the reason why they're doing well is because one of the earliest applications of cryptocurrencies is the black market, right? And so do we want to stamp that out, or is it a little bit more like the early days of the internet where we should be hesitant to stamp those kinds of things out because of what they might give birth to? So that's sort of my opinion on that. But yeah, Monero, I think I'm interested in VeChain. Lisk is interesting. Cardano is interesting. These are all much, except for Cardano, these are all much smaller than. Next question. Oh, you asked a question about sovereign ones, right? Why would a sovereign country want to do it?
Right.
Okay, so obviously if a country launches their own cryptocurrency, it's going to be really tempting for them to make it centrally controlled.
Yeah.
Obviously, they're going to try to make it centrally controlled, which in my opinion, it won't be a true cryptocurrency if that's the case. But many countries are already doing this. And I think the chances of us seeing some very popular, like if Switzerland, for example, launched like a relatively distributed and fairly decentralized cryptocurrency, I think it would be pretty popular. I think a lot of people would pick it because chances are it would be pretty stable, first of all. And a lot of people trust the Swiss with their banking privacy, right? That's what they're kind of known for. So these countries are going to want to do this, most likely.
Is the idea in the future that it's going to be like a low friction way of doing payments, and that's why they want to have a cryptocurrency?
It's already super low friction,
okay.
So that's already, it's not scaling as well as we'd like, but it's already super low friction. So that's already there.
Yeah.
But and right now there's a ton of different entities that we call them rent seekers. These are companies and businesses and central authorities that already have an infrastructure for payments, and they get fees from that. So PayPal's an obvious example. Right. I think here in the US we have a system called Swift, and Swift has intrinsic inefficiencies in it, which will always make it expensive. So yes, will Swift be disrupted? Certainly. And could sovereign cryptocurrencies be launched that are better than Swift? Absolutely. Absolutely. Does that answer your question?
Yeah, it's just like, I guess the other thing that was kind of related to what Monica was saying, which is like without a Fed system setting rates and stuff, like how do you set monetary policy for something that's decentralized?
Ooh, good question. Yeah.
Yeah.
So I think, I don't know. We're so far away from that. It's really hard to say.
It's just like, yeah, countercyclical policy is like really important.
Yeah, this is a tough one. All I can say is that this is sort of the new monetary policy that's sort of leading the way. And people don't really want to talk about it because it threatens the current monetary policy. Yeah, it's just, look at it with an open mind, and you can see the future ahead, how this is really powerful.
Anyone who says they know what's going to happen in that department, they're probably lying. I mean, there are some economists that have been studying decentralized currencies for 20 years. I mean, even they say they don't know what's going to happen, but they have some guesses. I've seen lots of people say that the whole system will be so different that it'll be unrecognizable. I've heard other people say that we'll continue to have centralized forces that guide this democratized blob in the right direction. So both outcomes are, at this point, in my opinion, equally likely.
Sure. Okay. Thanks.
So you talked about the Swiss they come up with this centralized thing. So I'm just very curious, what happens to the people, and I am just talking about from Indian people's standpoint, a lot of ultra rich people, take all their money and, they send it to Swiss bank. That's where the money is managed. And I'm sure that happens here as well.
Sure.
So what happens with that then? Just like the money?
Well, three things could happen. One, they could be the value of their currencies that they're currently storing, so probably US dollars, probably owning some gold, probably some equities, probably some land ownership. It could be the case that some of those assets go to zero, right? It could be the case that those assets are in the future are worth nothing. And that's possible. I'm not saying that's going to happen. In fact, I think it's probably pretty unlikely that would happen.
I mean, that's just any currency, though, right?
Yeah.
Like you can,
any
inflation or deflation, whatever. Like it's just another factor that's factoring into that.
Exactly. So just to repeat what Liana said, just like any currency can go to zero due to rampant hyperinflation. And we've seen that happen in Venezuela, and then recently we saw that happen, I believe, in a sub-Saharan country. Was it not Kenya?
Zimbabwe.
Was it Zimbabwe? Yes, it was Zimbabwe. So, you saw that famous $1 trillion Zimbabwe bill, right? Like, that's we haven't seen it really happen in the U.S. in a really long time, which is one of the reasons why the U.S. dollar is hoarded and collected all around the world, because people believe it's the most trustworthy. But it's not out of the question. Like it's theoretically possible that you could have that happen to the U.S. dollar, and some people are of the belief that cryptocurrencies are a great way to hedge against that or to protect yourself against that. I'm not here saying it one way or the other. I'm not making a recommendation here today, but I'm sticking to the facts. Certainly, cryptocurrencies have the potential to bring economic stability worldwide and prevent hyperinflation. That's certainly a possibility. Okay, let's take another YouTube question.
Okay, that's actually from the NowLab channel. So from
great.
Kevin Oyang, follow-up question for POW/hybrid. POW-based currencies, curious on your thoughts on potential ways to discourage purposeful centralization by large parties.
Ooh.
And things like
51% of tax.
By those holding a majority.
Yeah. Okay. Cool. I knew where he was going with that question. We didn't put in 51% of tax into this deck. It's a bit of a rabbit hole, but we'll do our best. You want to start us off?
Yeah, I don't think I'm prepared to answer this.
Okay, I'll start us off, and he knows more than me, but I speak about this more often. So 51% of tax. It's actually not 51%. It's just more than 50%. They just call it 51% of tax for convenience sake. It's where a huge number of miners all collude with one another and are. Oh, we're having a problem with our. Oh, sorry. It's where a huge number of nodes on the mining network collude with one another and essentially say, this is the correct blockchain, this is not. Just arbitrarily, they all agree that all those transactions that happened over here, nope, those never happened. These ones did. And once you control 51% of a network, you control the truth, right? So if you control the truth, then you can just lie about transactions to artificially enrich certain individuals or certain nations. And so, for example, if any one nation all of a sudden had a massive increase in cryptographic hashing power and on the say, for example, the Bitcoin blockchain, and they suddenly had 75% of all mining was being done by one central organization, yeah, that would probably ruin that cryptocurrency, because then it would no longer be decentralized. So that is just as regulation is an inherent risk to many of these cryptocurrencies, so too is our 51% of tax. I hope that answers the question.
Okay. And then the second question, Alberto, do you have any follow-up?
Oh, no.
Okay, so the second question being POS specifically for Ethereum is projecting to be around within 3% ballpark. How do you think this will play out within the next few years due to drastically reduced incentive for operating a node?
Okay, so we already know the answer to this for NEO and several other, I think Lisk as well. So there's several cryptocurrencies that already used proof of stake, and the results so far are not that great. Yes, the transaction fees are low, and yes, the transaction times are low. So in that sense, the proof of stake has been a success. But so far, no one has come out with a white paper that lends any sort of concrete, reliable first principles based reasoning for why that would be a stable system as things scale. So the belief right now is that as we watch, take any existing proof of stake system that's on the market today and watch it scale the way Bitcoin has, it'll probably break. That's what most people are saying. And I'm not saying that, I'm not saying it one way or the other, but I mean, I have no idea, honestly, if they will scale, but we're going to find out real soon. I think Neo is ramping up really quickly. Meanwhile, Ethereum is actually being very measured and very careful. They're not just switching over to proof of stake just like that. In fact, they're experimenting with sharding and the Casper network, and they have there are many different competing solutions within the Ethereum community. Ethereum has one of the largest number of coders. Bitcoin and Ethereum have between the two of them, they have something like, I mean, I don't remember what the stat is, but it was the overwhelming majority of coders worldwide are working either on Bitcoin or Ethereum. And they have the two largest networks of coders. And within the Ethereum community, you have tons of competing solutions. And some of them are pro proof of stake, others are not. So I'm not sure what he meant by about the 3% thing, though. Is that the, maybe we can get clarification on that.
Yeah.
Yeah, maybe just respond and see what they say. But hopefully that answers the question.
And the beauty of open source software is that anybody can contribute solutions to a problem here. If you have a solution, just submit it and people will look into it. And if it makes sense, they will apply it. And since it's just a software, when we get close to a problem, someone will probably come up with a solution and resolve the issue. So so far, I don't think we're close enough to that sort of problem yet.
It's still very early days. So I think our time is pretty much up. It's
Can
one.
I respond?
Oh yeah, you got a response?
Yeah,
Okay,
it's a
great.
3% yield incentive for holders to actually stake.
Oh, the yield. Okay, so the yield on staking your coins. Yeah, sorry. Okay, so the yield, the proposed yield, I imagine I didn't even know this, but for Ethereum, I guess, is 3% return on your coins that you stake. So very different cryptocurrencies have different methods by which they do this and different rates of return. I guess that was just an initial guess for them. It's hard to say what they'll actually end up doing on Ethereum, but take a look at Neo. I think the Neo is the furthest ahead on proof of stake. So take a look at them, and they're being used as a guinea pig, and Ethereum doesn't want the bad press. If anything goes terribly wrong, they don't want their brand name ruined by it. So whereas Neo is, I think, much more daring in their approach. So take a look at Neo and see where they're at. And let's use them like the canary in the coal mine or the guinea pig. My opinion on that one. So that's all the time we have for. Unless there's any pressing questions, we're going to wrap up here. Okay, thank you everyone for coming today, and thank you everyone online. How many people do we have online anyway?
40.
We had 40 people online. That's pretty awesome. So that's more than we have in this room. So thank you for joining everybody, and stay tuned for the next one.